We're not going to tell you how, but we're going to kind of imply that you can do it. And so go. And yeah, I remember that too. So yeah, really, really brilliant memories. Look, I want to talk to you about Bitcoin today. I want to briefly tell you when I first heard about Bitcoin, because it involves a friend of yours. In 2013, I was doing my show London Real after I quit my job in banking. I couldn't take it anymore. And I had heard about this thing called Bitcoin, and I put out on Twitter, who's the one that can tell me about this instrument? And this one name came up in London, and it was Max Kaiser. And so after a couple tweets back and forth, as we called each other out and sized each other up, Max showed up in my kitchen here in Shoreditch. And I didn't know if we were going to have a fight or what. And we had a broadcast. And for 90 minutes, Max schooled me on Bitcoin. And I think I just bought 2 for 85 pounds. I was complaining. There was no market makers, the order book system. And Max really laid it out. And that was my first really experience with it. And that episode's still up. It's fascinating to watch now. And then I didn't know what to do with it. And so in 2015, 17, and 19, Andreas Antonopoulos came back and would always tell us about what was happening and what it could be in the future of money. But again, it didn't hook me. And it wasn't until this year when I started looking at what was going on in DeFi that I got reminded about what I was doing on Wall Street in the 90s. And I thought, wow, this is crazy, because I used to do this 30 years ago and now other people are. And we can talk about that stuff later. Tell me about your experience with Bitcoin, because I know you knew of it back in 2013, but I think it wasn't until last year where you really saw it.
You know, in my professional life, I've run MicroStrategy, which is an enterprise software company, for 30 years. And I'm a public company CEO. And most of my mental energy was consumed by competing against Oracle and IBM and Microsoft and SAP, and selling enterprise software to everybody on earth. Part of what I did was run a treasury, and our treasury at MicroStrategy primarily consisted of a very conservative, conventional corporate strategy of hold cash and short-dated sovereign debt. And that's what I did for a long time. And occasionally we would take that treasury cash, we'd buy our own stock back. But we didn't pursue any other investment agenda with it. In my private life, as I was a private investor, and there I was a tech investor. I bought Apple, I bought Amazon, I bought Facebook, I bought Google. I wrote about why I bought those things in the mobile wave. But the summary is the best investment ideas of the century, I believe, are you buy into a digital network that is dematerializing a product or a service, or some kind of idea in the civilization, and you wait. Right? Facebook dematerialized friendship. And Apple dematerialized everything you could hold in your hand. It dematerialized wallets and cameras and photos. And Google dematerialized information and books and video. And Amazon dematerialized storefronts. And so those digital networks that dematerialize things, they grew through the web era. And we know that story. And then when the mobile era came along, all that software mobilized, and pretty soon you had a store in your hand called Amazon, and you had a library in your hand called iBooks, and you had friendship and relationships in your hand called Facebook, and you had a camera in your hand, and probably every other mobile device, a tape recorder, the like, and Apple, and I kind of rode that wave for a decade. And in 2020, I knew Bitcoin was around. I knew some people use Bitcoin for something or other. I also, thought it was kind of cool that you could go on markets and bet on who was going to win an election, if you remember that. And I thought online poker was cool. And I thought there were a lot of things that were cool, but I classified them as novelties. I classified Apple, Amazon, Facebook, Google as good investments based on a digital network. And my professional approach was I invest in short-dated treasuries. Then March 2020 hit, the money supply started expanding at 3 times the normal rate. We had lockdowns which shut down Main Street, and we had a V-shaped recovery on Wall Street. And so between March and June, as I watched Wall Street recover, and if you look at the S&P index and the stock market for the past 12 months, it's just straight up and to the right. It's like there is no crisis.
Yeah.
And if you're living on Main Street, Main Street hasn't recovered. I mean, the cruise lines aren't up and running. The airlines have been impaired. The hotels are impaired. Lots of manufacturing business are struggling. There's rampant problems in getting labor. There's rampant supply chain issues, and there's shortages. And so that dichotomy between the recovery of Wall Street and the impairment of Main Street caused me to question my premises about money. I started by questioning my premises about Treasury policy. Brian, I had $550 million in cash, and it was yielding 0% interest. And when the Fed said, we're not even thinking about raising interest rates, the message was, for the next 4 years, you'll get 0% interest on $500 million and you'll like it. Then I started thinking, then I watched Wall Street recover. And if the S&P, if we actually look at S&P performance over the last 12 months, it's up 37%, Brian. And so if you had $1 billion and you held it in cash, you're up 0%. And if you held it in S&P index, you're up 37%. If you took the same $1 billion of cash and you bought gold, you're up minus 72 basis points. That is, you're up 0%. If you invested in Bitcoin, you're up 269%. So what is the message, right, that the world's trying to tell you? It's that we expanded the money supply. If your long-term savings strategy is put your money in a bank account as dollars or euros, then your money lost, call it 37% of its purchasing power, right? If you put your money into an ETF or S&P index, your money held its purchasing power. If you put your money into Bitcoin, it gained purchasing power. And so as a corporate fiduciary, I got $500 million. What am I going to do? Well, I don't want to hold it in cash when I know that the currency is being devalued and the interest rate is 0. That's a negative real yield. If you calculate negative real yield based on CPI, you might say to yourself, oh, it's only minus 2% negative real yield, or minus the CPI now is like 5%, minus 5% negative real yield. But if you calculate inflation based upon asset inflation, the asset inflation rate for a portfolio of companies is 37%. So your negative real yield is minus 37%. And the rule of 72 tells you that you lose half your money in 2 years at that rate.
Wow.
You lose 90% of your money in 10 years. So when the negative real yield got to minus 37%, Brian, it's kind of like you crank the temperature up in my hot tub to 250 degrees, and I jumped out. So how did I discover Bitcoin? The answer is, it wasn't a problem for me until March of 2020. It was an opportunity, but I had other opportunities, and it wasn't a clear enough opportunity that I would change my life in order to go do this thing. But in March of 2020, the big tech trade came to its end. Amazon was, $3,200 a share. Well, I wrote it from $300 a share to $3,200 a share. It wasn't going to go up by a factor of 10 or 20 from there. Apple, Amazon, Facebook, and Google were acknowledged digital monopolies and dominant networks, and every 22-year-old taxi cab driver could have told you that those were the winners by March to June of 2020. So where are you going to put your money? You can't, I mean, big tech is not like the compelling new thing. It's the understood thing. My strategy as a tech investor, Brian, is you buy something that everybody in the world needs, nobody can stop, and 99% of the world doesn't understand. And that would be the definition of Facebook in 2011 or 2012 or Google or Amazon. You could, if you go back to 2010, you could see Apple, Amazon, Facebook, Google are unstoppable. Everybody needs them. And yet 98% of the people on Wall Street would have told you when Apple doubles, you should sell some, take off the top, and you should diversify into HP and IBM and other. And when technology is more than 20% of your portfolio, you should sell technology and you should diversify into non-technology. So the diversification in that case is selling the winner to buy the losers. And of course, the idiocy is Apple became 150% of the profit of every mobile phone company in the world. Everybody else in the world lost money to compete with Apple, which made all the money. Okay. That's why you don't diversify from the category killer.